Thank you so much, and thank you for your patience, and I thank AFM for inviting me here today. I will not take too much time. I know it's end of the day, and all of you have a long, long day. So I'll keep it short and brief and just convey the key messages. Louder? Okay. So I'll just keep it short and brief and convey the key messages, and thank you for your patience. Can I have the slides, please? Yeah. So very simple. I'll talk about the concept of Quantamental. Is that the future of investing, right? And I'll share thoughts about this concept. Please move ahead. Yeah, sorry, okay. Okay, so what you have to realize is that what has, the regime, the macro regime has changed before COVID and after COVID. Essentially, the point is that various factors like your interest rates were lower earlier, they're much higher now. Inflation was much lower earlier, it's much higher now. Your business cycles, most importantly, were predictable, they were longer. Now, you have very shorter business cycles. The government is more active, regulation is more tight, things have changed completely. And even FI investments has grown. And all of you have seen that the geopolitical risk, the uncertainty in the global environment has gone up dramatically. The Ukraine war, etc. You can't predict what's happening. So dynamic and rapid change is the order of the day. So in this context, fund managers will find it more difficult to generate alpha. Aapko kya chahiye? You need the fund manager to give you consistent, predictable alpha because your customer is asking. If for 6 months, 1 year, the performance is down, while of course you manage the customer and you are patient with them, but still, he'll say, look, can I put my money somewhere else? Because some other fund is doing better. So the fund manager has to keep giving alpha, right? But what's the challenge? You see? Okay, yeah, anyway. So earlier, lower cost of capital, higher liquidity in the market, money was available, quantitative easing was there, predictable returns, a buy and hold kind of strategy would work before COVID, right? What has happened is after COVID, higher interest rates, there's very short business cycles. You've seen so many sectors suddenly coming up dramatically, right? And global uncertainty is there. So a buy and hold strategy may not work. It might work over 4 or 5 or 6 or 7 years, but your client often is not patient and they're seeing returns going away. So how does the fund manager now, his challenge is, how do I give consistent alpha and what should be my most effective investment strategy? So you've heard about Quant coming in now, very strongly in India. It was there in the US, it's strong in India as well. And we anyway know fundamentals and value and growth. So and every fund manager typically will have an investment style, which may work sometimes, may not work sometimes, especially now because the environment is changing so rapidly, right? So what do we do? So quick pros and cons, all of you know, nothing rocket science here. The fundamental, longer term focus, you understand the business better. And you have to analyze and know that sector very well. So you need the expertise, but obviously it's time consuming. There could be subjective assessments, there could be a bias, right? On the quant side, it uses large amounts of data. It's quicker, faster. You can build in the risk management protocols as well, but it's a function of the data. So if you have the data and the quality is good, it'll give you better results. And you have to keep on calibrating that model. It's complex. So both areas have their pros and cons. One is, what do you do? Which one do you choose? So what we found is that a combination of these two is giving very good results. Because if your objective is consistent, sustainable alpha, which is what your customer needs, this approach is working well. So quant plus fundamental is quantamental, right? So man plus machine, or machine plus man, is giving you what I'm calling, instead of the typical AI that you know, instead of artificial intelligence, is giving you actual intelligence, or what I call alpha intelligence. That's the new AI for us, right? So man plus machine. We also say internally it is IQ plus EQ. Machine ka jo IQ hai or jo EQ hai, the emotions of the individual manager, put them together, you get better, superior results, right? So again, if you look at Quantamental, an enhanced Quantamental investing process is not just saying, अच्छा मेरा एक quant team है और एक मेरा fundamental team है and वो parallel काम कर रहे हैं. Many fund houses sometimes put up a quant team, but I'll protect my fund manager जो है, let him do what he wants to do, my fundamental fund manager. But that's not the answer. The answer is it has to be a combination of the two. It is an integrated approach. Then you have the enhanced Quantamental approach, which means that you get the best of both worlds. So let's say in your quant model, you have statistics, you have data, you look at patterns, etc. You follow the trends. Plus, with the fundamental side, you have your, your standard financials, KPIs, your the company health metrics, and so on, the management quality, intrinsic value. Put them together, and what you get basically is a model and an approach that gets the best of both worlds. You have lesser, human biases. You are more efficient. Most importantly, it makes you nimble. Because what the fund manager can't do immediately, the computer can do very quickly and tell you exactly where the opportunity is. So in a dynamic world where things are changing so fast, a quantamental approach helps you move with the market. And if you have a good risk management in place, when the market goes down, you can also protect your drawdowns, right? Because the model helps you in that. And you can write the trends, both positive, negative, appropriately. And I'm sure many of you already are doing it. The people I speak to people, they said in many ways, they're doing something like this. Look at technicals, they look at multiple things. But putting it together as a fund house philosophy is something that helps across the board, especially in these times. An example of something like the way it would work is, the quant model would typically, for example, take a 3-factor model, something that we've tried out. You apply it on the NSE 500 stocks. The factors could be looking at low volatility stocks, stocks with a higher momentum, and with a low valuation. And then obviously you score and you rank the stocks, give them a weightage. And net, the computer gives you a particular recommendation of a portfolio, which then goes to the fund manager. So the input of that is what the fund manager takes. And to that, they will look at their, in a way, a traffic signal, right? Should I remove some stocks? Should I add back some stocks where I have a high conviction, but the model hasn't picked up? And should I change the weightage of certain stocks that the model has set? Because I have seen the recent quarterly results, I have understood the government policy, which the model can't pick up, right? Or I may have, suddenly there's some crash in the stock today, which the model can't react to. So the fund manager then comes in, overlays their view on the model ka input. And then you build a final risk-adjusted portfolio. And because when you build the model, you optimize the model to give alpha. So the way you build the factors and the weightages is designed to give alpha. So the thing is, you test the model to make sure it is alpha. And if you have a reasonably good fund manager who then has high conviction on what they want to do, then you have a double benefit because both are alpha accretive. Your machine is giving you alpha, and so is the model. In a way, if you heard in ChatGPT, they say co-pilot, right? So many ways, it's like a co-pilot that we have built together. And this is just an example of, this is my last slide. So like I said, I won't take too long. Message is quite simple and clear. But here's what it's worked in terms of how the results have been. We've done the backtesting of the model. The first row is the model data, the model returns, as of 30th November. So you ran that model 30th November, and point to point, 1 month, 3 months, 1 year, 2 years, what the returns are. Second is your benchmark, and therefore the green line is the alpha against the benchmark. And below is your Nifty. Of course, the markets are high, so obviously the performance is good, but more importantly, against the benchmark, there is clear alpha, right? And it's fairly significant. If you see the alpha out here, it can be over time. It's at least in double digits very clearly. So that is in a nutshell in what I wanted to communicate in a very simple way. That I said I won't take too much of your time, but in a summary, essentially, it is volatile times, things changing very fast. You have to have a fund manager who's nimble and agile. The way to do it is that you have to combine man plus machine. It's today's age, and using the two, get the best of both worlds. And of course, the key thing is you optimize your entire approach to consistent, sustainable alpha in a very disciplined, process-led way. And the key thing is that the two teams is one team. It's not two teams, right? It's one team who's working as one unit who's working on this kind of an approach. And that, in a nutshell, is the approach that maybe then this Quantamental should be the way of the future because we are in times that are volatile and fast changing. Thank you so much.